Okay, thank you. Thank you all for joining us today for this latest in our World Economic Roundtable series on the global pandemic crisis. As you may know, the Roundtable was begun over a decade ago by our founder, Cheryl Schwenninger, then working for the New American Foundation. Cheryl felt that the devastation wrought by the global financial crisis and the Great Recession required a serious re-examination of political and financial economics. As that crisis and its anemic and lengthy recovery played out, it became clear that many beliefs of the economic mainstream needed to be challenged and new economic thinking was overdue. Our work over that period saw the rejection of quite a number of shibboleths and the emergence of what were formerly heterodox views into the mainstream. More about that in a moment. First, and most sadly, I must recognize and memorialize Cheryl Schwenninger, who passed away suddenly last week. Cheryl was responsible for bringing so many of us together a decade ago. We are grateful to him for many things: his wisdom, his boundless encouragement of our intellectual pursuits, and his encyclopedic knowledge of political economic history. He was one of the righteous amongst us in pursuit of a better world and a common truth. And he is, and will continue to be, sorely missed. We dedicate this session and the World Economic Roundtable itself to Cheryl's memory. More information on memorials to Cheryl will be forthcoming. Today's program brings together Stephanie Kelton, author of The Deficit Myth, Modern Monetary Theory and the Birth of the People's Economy, and a professor of economics and public policy at Stony Brook University, with Paul Allen McCulley, formerly the Chief Economist of PIMCO and an adjunct professor of macroeconomics at both Cornell and Georgetown Universities. Kelton and McCulley are being joined in conversation by Neil Irwin, senior economics correspondent at the New York Times, for a discussion of a developing post-Keynesian synthesis in macroeconomics. The economic crises of this young century have been breathtaking, whether precipitated via acts of stateless war, via irresponsible stewardship of our financial institutions and their regulators, or via an invisible global virus. The U.S. economy and that of the world has been pummeled repeatedly. In addition to, and only sometimes as the result of, these events, a slew of economic outcomes anticipated by mainstream economic theory have, in many instances, failed to materialize over a quarter century. During that time, a vibrant, until now quite heterodox, post-Keynesian school of macroeconomics has evolved to the point at which nearly all are taking notice, whatever their points of view. Again, if for no other reason, then many of the outcomes that such analysis anticipates have actually materialized. As the economies of the world have globalized and we've accumulated 45 years of experience and observations of economic behavior in markets since the end of the Bretton Woods system. Post-Keynesian policy solutions are now being actively discussed and debated around the world. Modern monetary theory, widely discussed in recent years, exists within broader post-Keynesian analysis of capitalism's institutions, structures, and dynamics that explain much of the dysfunction in advanced nations over this crisis-filled century. We hope that you'll join in after the initial presentations today to discuss what you hear, especially under the dire circumstances in which we presently find ourselves, as it should be clear to all that the financial and economic edifice reconstructed on the ruins of a pre-recession economy is once again inadequate to the task of addressing an existential crisis. Please use the chat box in your screen to indicate your interest in asking questions during the Q&A portion of our program. Those wishing the floor, or screen as it were, will then be recognized by our coordinator, Ben Kolansky, and unmuted at that time. I now turn the screen over to Neil Irwin. Neil, please take it away.
Thank you so much, Dan. Good afternoon, everyone. It's an honor to be here to discuss some of the deepest, most important, and most fundamental elements of how the economy works. We have ideal panelists to do that. Our topic today is a developing post-Keynesian synthesis which is quite a task to undertake given that we have 90 minutes to work with. But if anyone can offer a rethink of all of modern macroeconomics in 90 minutes, I would trust Paul McCulley and Stephanie Kelton to do so. Before we begin, let me try and frame this discussion with a little bit of my own vantage point as somebody who grew up in the 80s and 90s and has been an adult working as an economics reporter throughout the 2000s. This is kind of my own vantage point on the recent history of economic thought. When I was an undergraduate economics major in the late 1990s, I learned a version of how the macroeconomy works that was presented to me as a kind of settled consensus, the kind of thing that all right-thinking people could agree upon. And there might be disagreements among economists, there always are, but there are some elements of that consensus that I was taught that was kind of presented as just the way things are. So here are some elements of what that consensus looked like. One, fiscal deficits are almost always bad and irresponsible. Government borrowing crowds out private sector borrowing, pushes up interest rates, that lowers the economy's longer-term growth potential and puts the country at the risk of a fiscal crisis. To the degree in this consensus deficits ever make sense, it's short-term stimulus when the economy is producing below potential. And the corollary to that, this was the late 1990s, things were going pretty well. The economic boom of the late 90s represented a vindication of this view, that it was a result of the low interest rates and the falling deficits of the early 90s. Another part of this consensus was that monetary policy is really the better tool for short-term economic stabilization. It can act quickly and decisively, and it's guided by these wise, independent economists at the Federal Reserve who will do what's right for the economy, not for their own re-election prospects. That these technocrats are really better at stabilization than elected officials who are prone to short-sighted fiscal profligacy. Another element is that there's this trade-off between employment and inflation. And if the jobless rate goes too low, it'll just generate higher prices. Yeah, we might have outgrown the simplistic Keynesian version of this from the 1960s, but once you build in a role for inflation expectations and the importance of central bank credibility, you had a reliable model for how inflation happens and what the Fed could and should do to stop it. Finally, one more element of this kind of consensus that I was taught 25 years ago is that there's a trade-off between growth and equality. Efforts to reduce inequality will come at the cost of weaker growth, and conversely, policies that encourage capital formation, like low taxes on capital income, will create more robust growth, expand the size of the economic pie. As I began my own career as an economics reporter in Washington in the 2000s, it's striking how widely those views were shared. You could go to an event at a center-left think tank or a center-right think tank, and people might disagree around the edges, but some of these basic ideas were widely held. It would be true if you talked to a Bush economic advisor or an Obama economic advisor. It was true if you went to the conference at Jackson Hole where the central bankers get together and talk about things every summer. At the same time, as this was a very widely held consensus, especially in policy circles in the early 2000s, the world was not really working the way it was supposed to. For example, throughout the 2000s, the United States has expanded its budget deficit, starting in the Bush years with tax cuts and the wars, then the global financial crisis, now the Trump years with more tax cuts. But even as deficits have expanded, interest rates have been falling toward all-time lows. It's hard to find evidence that government borrowing is crowding out the private sector. If anything, right now the corporate bond market has been booming. Companies can get access to credit very easily. The Fed's ability to manage the economic cycle has started to look an awfully lot less powerful than it did 25 years ago, especially since hitting the zero lower bound on short-term interest rates at the end of 2008. Inflation has been persistently too low rather than too high. This doctrine of preemptive tightening of monetary policy to prevent inflation looks outdated, to put it generously, as Chairman Jay Powell acknowledged just the other day. And finally, after many years of rising inequality and tax policy aimed at encouraging capital investment, by many measures, the US economy is more sclerotic than ever. Overall growth has been persistently weak, productivity growth has been low, and average wages never really accelerated during the last expansion. All of those are things I would have said if we had held this session back in January, when the unemployment rate was 3.7% or whatever. But now we're in a different situation. The economy is facing a pandemic-induced crisis, arguably deeper and more profound than the 2008 crisis even. And after initial aggressive action from both fiscal authorities and the Fed, we're now at a moment of political stalemate over further action. But aside from our current moment, which is tremendously important, there's a bigger question I hope we can wrestle with today. which is that old macroeconomic consensus my professors taught me 25 years ago looks more and more outdated as the real world has not acted the way the mental model predicted it would. Fortunately, today we have two panelists who have identified and critiqued those contradictions and those problems with the old consensus earlier and ahead of the curve. They're here to share their views of what needs to change in our understanding of how the world works. And I would invite first Stephanie and then Paul to start with kind of their own voyage on these questions and how their own understanding of the way the macroeconomy works has evolved through these last 20, 30 years. So Stephanie, can we start with you?
Yes, thank you very much. In fact, you know, I'm tempted to start with a joke. I don't know. I wanted to say something like, you know, a wise man once said, never go to war against a Sicilian when death is on the line. And I feel like never follow Paul McCulley is sort of the same sort of advice, right? So thank you for putting me first. You know, one of the things that I just discovered, Neil, listening to you is that if we didn't go through the same undergraduate program, we certainly went through an undergraduate program probably the same within a couple of years of one another. I think we must be about the same age. And we had an economics training that it was probably very, very similar experiences wherever you might have gone. I was in California. I think that I had some advantages in the sense that I was actually an undergrad studying economics in a department that had some heterodox economists in it. And so from a very early age, I was exposed to and reading things by Thorstein Veblen and Hyman Minsky. I was reading British economists, macroeconomists like Victoria Chick and Sheila Dow, who, you know, I was reading in the Post-Keynesian tradition. And I think that benefited me in a lot of ways, because in a sense, I was predisposed to go into graduate school already having my head filled with sort of critiques of the sort of things that I was taught as an undergraduate. So I was suspicious of many of the things that I encountered while a graduate student at Cambridge University. And then I went on to do my PhD at the New School. So I've had, I think, the benefit of being in places where there were people all at every step of the way critiquing, right? Stress testing, questioning many of the sort of mainstream economic models. So, you know, I look at the laundry list of things that you just laid out, the sort of things that we've been taught to believe, whether it's that deficits force governments into competition for scarce financial resources, that they have to borrow and compete for financing against the private sector, and that when government deficits increase, that competition intensifies, driving up interest rates, crowding out private investment, undermining longer-term productivity and growth, so on and so forth. I never sort of fell into that. I came in always sort of suspicious of that. I worked with people along the way like Wynne Godley, the famous British economist who sort of pioneered work in the sector balanced accounting framework. And so working with Godley along the way and reading his early critiques of the Euro project, for example, made it possible for me at a pretty early age, you know, in the 1990s, even when I was studying at Cambridge before the Euro was a reality, right? In the mid-90s, I was reading Wynne's work, and I had an understanding and appreciation then for the importance of governments operating with what we think of now as a sovereign currency, or to have monetary sovereignty. And reading Wynne and thinking about what it might mean for countries that abandon their sovereign currencies and begin borrowing in a foreign currency left me in a position, I think, decades before the mainstream really picked up on it, where you know, I could see the likelihood of difficulties arising as governments began borrowing in currencies that they couldn't issue. Was writing about in my own PhD dissertation and early publications about the possibility of debt crises and so forth. The Clinton surpluses were always suspicious to me, whereas the mainstream embraced them. The Congressional Budget Office looked at the budget outcomes in the late 90s and early 2000s and said the US is going to continue running surpluses as far as the eye can see, will eventually pay off the national debt. People like Wynne, Randy Ray, and others understood that the likelihood of that was extremely small and that the surpluses were in fact unsustainable. What is sustainable are fiscal deficits. What was unsustainable was the budget outcome under the Clinton year. So whether it was the euro, the Great Moderation, as you said, the Bush tax cuts, we saw, of course, the Trump administration and the House and Senate pass huge tax cuts at the end of 2017. There were economists at the time, big name economists, who warned that if the tax cuts passed, it would leave the government unable to act when the next downturn arrived, that we would not have the fiscal capacity to respond if the economy weakened. And, I was one of those voices that said, of course, this can't be correct, right? The Bush tax cuts didn't prevent the deficit from expanding during the Obama years. The expansion of the deficit in the Obama years didn't prevent Trump from pushing through tax cuts. The tax cuts didn't prevent Congress from responding to coronavirus. So anyway, that's just sort of a broad sweep, and some of it is just repetition to what you said, but they're all examples of things that I think the mainstream, whether it was a Great Moderation, the Euro project, tax cut, all of it has thrown up questions for us to wrestle with and to fill some deficiencies with the mainstream approach.
Great. Paul, why don't you kick us off with a bit of your arc on these themes?
My pleasure. I have the advantage or the disadvantage of being a decade older than Neil and Stephanie. So I started my journey professionally in 1981. I was in graduate school in 79 to 81. And that was a huge epic turning point. When I think in terms of it, it was the definition, if you will, of the macro landscape that we had lived with essentially for the next 40 years. And in and around that time, essentially, our profession centered on the need for a new paradigm post the gold standard. So the 70s in many respects was a period of turmoil in the profession because we were dealing with a existential change in the anchor of the system, which had been gold. And the new anchor effectively came with Paul Volcker, a very, very tall anchor, and essentially looked at monetary and fiscal policy as a division of labor. And probably the most famous paper I read during that time that really crystallized my thinking for the next 4 decades was Sargent and Wallace's famous paper, Some Unpleasant Monetarist Arithmetic, because theoretically, Volcker was operating under a monetarism, which had defeated Keynesianism. And Sargent and Wallace asked the question that I think we keep asking 4 decades later is, who dominates whom? Or differently, who disciplines whom? So essentially, I started my career with the whole notion that monetary and fiscal policy were in competition, and that monetary policy would be dominant for a lot of the reasons that Neil articulated, as well as the fact the starting point in 1980 was a inflation rate that was universally presumed to be too high. So that would be my beginning point of thinking in terms of monetary fiscal policy mix. And the synthesis at that juncture was monetary policy will dominate. And we saw that very much in the Reagan administration, in that Reagan had put in big tax cuts, theoretically or notionally, better put, supply side tax cuts, but would have Keynesian effect. But the fiscal stimulus of Reagan really didn't come through until effectively Volcker backed off in 1982. So that would be my beginning point, which is we got a monetary fiscal policy mix and monetary policy dominates. And in many respects, and Greenspan commented on this many years later, is the monetary fiscal mix with the monetary authority dominating the fiscal authority in many respects was trying to replicate the discipline of the gold standard. In fact, I think that Mr. Greenspan actually used those words and patted himself on the back. We've done pretty good. So essentially, we replicated the barbaric relic of the gold standard with a monetary policy dominant world. So that was my starting point. And then a decade later, it was really solidified for me when Bill Clinton came into the Oval Office. And he had run on a platform of fiscal stimulus, a tax cut for the middle class, and effectively was talked out of it after he was elected by Bob Rubin and Alan Greenspan, saying that monetary policy would remain easy if he didn't do his fiscal stimulus. And we saw a big bull flattening of the yield curve in '93. And that basically gave birth to this concept of expansionary austerity, that whatever you do on austerity on the fiscal policy side can be offset by monetary policy. And that really just anchored the whole notion of monetary policy dominance in the mix. And then I can fast forward, a lot further in time, and we will end discussion. But essentially, that's been the last 40 years, is monetary policy dominance over fiscal policy. At the beginning, because of inflation being too high, and then it morphed over time with the notion of efficiency and technocratic expertise, as Neil noted. But that really was the overall regime. And then it got codified in this century in a lot of various different ways. And I would summarize that is that going back 20 years ago, led by Ben Bernanke when he was in academia, the whole notion of inflation targeting took hold, which is a monetary policy dominant regime in the way it was envisioned at that time. And it became a very intensely technocratic sort of world of essentially running monetary policy with an inflation target and a Taylor rule, which embeds essentially the Phillips curve trade-off between inflation and unemployment. So we really codified, not just in theory, but in practice, a monetary policy dominant world. And then also over on the fiscal policy side, we also got technocratic, foolishly technocratic, but we got technocratic on the whole notion of any fiscal proposal had to be paid for, pay go, deficit neutrality. So your anchors in the system were an inflation target for the monetary authority and a deficit neutrality for the fiscal authority, and monetary policy would dominate. Now, in periods of exigency, in particular in the financial crisis, we saw a coming together of the two authorities, because it was absolutely necessary, of running the two authorities essentially as a consolidated balance sheet. But then right after that, there was the drive back to the notion we got to normalize monetary policy, and we spent a good chunk of the last 10 years trying to do that. So my whole backdrop on this whole thing comes from the notion that we've been in a monetary policy dominant world, essentially as a profession, treating the monetary authority as the de facto fourth branch of government, as a bulwark against inflation, against crowding out, against all those sorts of things that theoretically are bad about government. But it's morphed over time, but that's been the mindset. And that's what's changing now. And I liked your comment, Neil, that we think was going on before the virus hit for a lot of great reasons, not the least of which is the fact that inflation is the boogeyman who didn't show up. The right tail of the inflation distribution was cut off when we start looking at the deflationary tail. So that calls into question a lot of the conventional mainstream thinking, is when deflation in a sovereign currency world comes to the forefront, is that who disciplines who? Well, we got too much discipline going on here. So that was one core structural change that was feeding this discussion long before COVID. And the other was the whole notion that too much reliance on markets will ignore, which is essentially what we're talking about in a monetary policy dominant world, too much reliance on unfettered markets ignores collective action problems. And income and wealth inequality is a collective action problem made for democracy. So those were the two problems that were very much in place before COVID hit, which is that the fat tail for inflation had moved to deflation, and two, it was clear that the dark underbelly of capitalism and income inequality was a problem for democracy itself. So those were the preconditions for this change in the synthesis that we're talking about now, and COVID just turbocharged it to an extent that my head is still spinning in terms of the order of magnitude, that the fat tail of deflation has gotten fatter and fatter with the induced depression for the public health crisis. And at the same time, it's never been more clear that capitalism does have a dark underbelly. And it's not a criticism of capitalism, it's just the nature of the system that we will widen out the income and wealth inequality and create a society that doesn't pass a smell test of social justice. So, long-winded story, that's my 40-year journey to where we are now.
So Stephanie, I'm guessing you agree with most of that. Are there elements that you disagree with, or is that the construct that we're in, where this monetary versus fiscal dominance is changing beneath our feet?
I think, no, I agree with it. This is, I think it's clear that for decades, we collectively, globally, have relied on central banks to do the heavy lifting, right? It has been up to central banks, not just to maintain conditions for growth in so-called normal times, but they were the first line of defense against a weakening economy, right? And they were the ones who were supposed to lay the foundation for a recovery after a downturn. And it was really only after the financial crisis, as Paul said, when it became clear that you got up against the zero bound. And then we started doing some creative things, you know, with QE and other sort of things. And at that point, it begins to dawn on people. And by the way, people like Ben Bernanke, go before Congress. The guy is absolutely getting beaten up, right? Because yes, Congress did respond in the wake of the financial crisis with a package that at the time sounded pretty big, $787 billion, the American Recovery and Reinvestment Act. It sounded like a huge sum of money then. Now we're well into the multi-trillions. But we got that one-off piece of legislation, and then effectively fiscal policy went AWOL, leaving central banks to deal with the fallout on their own. So poor Bernanke goes in, sits before members of Congress. They're beating the guy up. They're saying, what is taking so long? Why haven't you fixed this economy yet? And he responds by saying, and I remember his words very clearly, he said, let me just say that monetary policy is not a panacea. It is not even the ideal tool. Now, when he said those words, it's not the ideal tool, I thought, well, what the hell? It's the tool, right? It's the tool. Congress has told the Fed, you're in charge. You have the dual mandate. Your job is to maintain full employment, fix this economy. So, you sort of wash your hands of the thing and say, well, it's up to the central bank to fix it. And here's the chairman of the Fed saying, it's not the ideal tool. So what he's trying to say is, I need a partner in this. I need you to pull that fiscal lever again in his sort of subtle way. Now we're in a very different world where central bankers themselves are no longer being subtle, right? They're being very candid about the limitations of monetary policy. It was Draghi on his way out. It's Kuroda in Japan. It's Lagarde at the ECB helm now. It's Powell here in the US. We are hearing from central banks, we can't do it alone. We have to have you engaged. You have to stay in the game. You probably saw, you're at the New York Times, Neil, of course you saw Ben Bernanke's recent op-ed. I read that thing and it was as if he was writing directly to 535 members of Congress. That was a message to stay in the game. Don't do to this guy what you did to me. Do not do to Powell what you did to me when I was Fed chair during the Great Recession. So I absolutely agree with Paul. And I think that good news is that we're getting the message.
So I guess that's my question. I mean, help me understand the political economy here. Look, you're an economist, not a political strategist, but it seems like popular will among voters and elected officials for fiscal action seems to not be as persistent as you might think. And the fact that there was fiscal austerity in the US in 2011, that there was, there's already some voices arguing that there shouldn't be more, another bill here in 2020. As you say, Jay Powell is begging them to do more. Please help me out. What does that tell us, though, about the politics if this keeps happening, both in the US and in Europe and elsewhere?
Well, it reminds us, I don't know if it tells us, but it reminds us the politics are very broken. And I think it makes it clear why Janet Yellen, I think in her last speech at Jackson Hole, said one of the things we're going to need going forward. Now, this is in the recovery phase of the last business cycle upturn, right? And she's on her way out and she says, look, one of the things that we're going to have to work hard on and get better at is designing more powerful automatic stabilizers. That was what she said. And I think that she understood perfectly well that the next downturn will one day arrive, okay, it's here. And when it does, we need safeguards in place to protect us, to protect our economy against the highly likely scenario whereby Congress fails to do enough, right? That the budget needs to move in the right direction at the right moment, and that we cannot rely on a broken Congress to pull the lever, to stay engaged, to do what needs to be done, and that the best way to try to get better outcomes going forward was to strengthen the automatic stabilizer so that we could take some of the guesswork out, we could have the right things happening independent of congressional action, I think.
So Paul, is that consistent with what you were saying about kind of the reassertion of democracy and democratic values in an economic system, or are those different ideas?
Very much the same thing. And I would echo what Janet was saying, is that ultimately we need to have much more robust automatic stabilizers to deal with the business cycle issue. And I think that's where we're going to morph to in the years ahead. And automatic stabilizers have the benefit usually of being implemented in non-emergency times, and they don't look on their face to be expensive, if you will, and they can be implemented then, and then they can kick in when they are needed. And I'm actually jumping ahead, but I think that's where we're going to go in the years ahead, is a much more robust mosaic of automatic stabilizers, which basically make the deficit irrelevant in real time, because you've got Congress having pre-committed in law well before the emergency is that we're going to spend or not tax or increase the deficit, depending on how you want to look at it, when this event happens. So you don't have to have the decision-making in the event. You have the decision-making well before that. And hopefully the decision-making is informed by good technocratic expertise on what you need. And in some respects, it's kind of the moral version of a Taylor rule for fiscal policy, from the standpoint of these things will automatically happen. Obviously, it didn't in a Taylor rule where you had coefficients and all of that. But essentially, I think that's where we're going to. And I think Janet's plea is also going to be a forecast coming true in the fullness of time. From the standpoint of the political nonsense, and that's probably the most polite word I can use in this setting, the nonsense going on right now, I have to scratch my head. I really do. I mean, I know when the nonsense, truly the nonsense, took root. It was with the Tea Party, which was the bane of not just Ben's existence, but the nation's existence, and the whole notion that not only we're not going to stay the course with the fiscal stimulus coming out of the Great Recession, but we're going to go the other direction. And that codified, if you will, this notion of deficit neutrality and pay-go, pay-for, and essentially neutered fiscal policy. And that mindset has been in place now for about 8 years. You still hear it mouthed all the time here in this town. And I think it's still got its clinches into the to the body politic within the Beltway. So before we can properly get to a new world of robust fiscal stabilizers to deal with lots and lots of issues, I think we have to categorically bury this concept of deficit neutrality, and that things have to be paid for, and we're not there yet. I mean, the Republican Party, particularly the right wing of the Republican Party, is still worshiping at the Tea Party church. And I have to say, it leaves me absolutely befuddled, because you don't have to be a professional economist to recognize the incredible need for the opposite of austerity right now. So maybe somebody can give me an idea of why we're in this cul-de-sac that makes no sense, because to my way of thinking, any observer would think in terms that this concept that was introduced by the Tea Party is absolutely utter nonsense.
So Stephanie, you worked on Capitol Hill. How much is that kind of the 1970s consensus on macroeconomics, is that built into the machinery of legislation in ways that are problematic, the way the CBO scores things, the way OMB analyzes things, the way the Fed is going to respond? I mean, how much is there a evolution in thinking needed in the kind of institutions of economic policy?
Oh, it's very much built into the machinery. you know, when I was there, I don't think I saw a single piece of legislation introduced that did not have a pay for and was not deficit neutral. So everybody ran around, right? You have $1 trillion infrastructure bill, and you have a pay for which involves closing a bunch of tax loopholes offshores or something like that, right? To fully offset that. Every single thing, so that you can run around and look for co-sponsors and look for to extract a good score out of the Congressional Budget Office that says this is a great bill because it won't add to the deficit. The problem is that when you go around trying to get support for the infrastructure bill, the first question out of every staffer's mouth the entire time I was there was, what's your pay for? What's your pay for? Not what do you want to do? It's what's your pay for? Because I'll tell you right away whether it's toxic to my boss or not. Right. So when the infrastructure bill came up and the pay for involved closing a bunch of loopholes that were going to disproportionately hit people at the top of the, very, very top of the income ladder, there were many people, including many Democrats, who simply would not vote for that bill. So you get no infrastructure spending in a country where, the infrastructure is increasingly becoming sort of third world, right? With deferred maintenance year after year after year. We can't even do infrastructure spending because we can't get a bill through because we approach everything with this pay-go mentality, and we think everything has to be fully offset rather than recognizing that when the economy has the capacity to safely absorb that $1 trillion of new spending, let's say rolled out over 4 years, you can do these sorts of things. There's low-hanging fruit, and you don't always need an offset because there is enough capacity in the economy to safely handle that spending without pushing inflation above, let's say, the Fed's 2% target. So there is no one doing that sort of analysis. There's nobody at CBO or OMB who's evaluating proposed new spending based on whether there's inflation risk and whether lawmakers have appropriately mitigated the inflation risk with any offsets, so-called pay-fors, as necessary. Nobody thinks about that. I never heard anyone talk about inflation risk when I worked on the Hill. That's the purview of the Fed. So we don't even have to think about that. We just have to avoid adding to the deficit. And from where I come from, that's the wrong way to approach the federal budgeting process. So yes, I think we need to transform the whole thing, right? The federal budgeting process itself, the way we evaluate proposed new spending, what we ask of CBO or other agencies in terms of feedback, so that we can help guide lawmakers with reasonable, rigorous feedback about the risks and rewards of any proposed new spending, but without centering everything on, does it add to the deficit? Does it increase this thing we call the national debt?
So what does that look like, though? So if President Biden on January 21st, or President Trump for that matter, calls you up and says, hey, how much can we really afford to do on COVID response, on everything else? Do we have a framework? Does MMT have a framework for figuring out where those constraints actually are?
Yeah, I mean, look, in a couple of years ago, I co-authored a pretty beefy report. We published it through the Levy Economics Institute. They'll just give you one example, although we did two. This one was on student debt cancellation. And so we were approached and we were asked to do a macroeconomic analysis. What would be the economic impacts of canceling what was then all outstanding $1.5 or $6 trillion in student loan debt? So we ran the macro analysis. We ran it using a large-scale macro model known as the FAIR model, which is named after Ray Fair, who's an economist at Yale, I'm sure you know. And we also worked with Mark Zandi's team at Moody's. So we used two different models. We ran the analysis. We basically asked the hypothetical. What would happen if we canceled all the outstanding student loan debt and we didn't offset it? That's where I would start with each question. Start with no offsets, and then let the analysis tell you whether the macroeconomic effects would produce such an impulse to inflation that you need to start building in offsets. And then you have to get the offsets right if they're needed. The good news is, I say that recognizing I don't mean it as good news, the benefit we have, let me say, in the current environment with coronavirus, with unemployment rates where they are, with the amount of slack in the economy, is that there is a whole lot more fiscal space today to do things than there was 2 years ago, 2.5 years ago, when we started working on that report. So the answer is, I would go, case by case, policy proposal by policy proposal. You can model this stuff, and we did it, and there are others who can do it, and we can provide the kind of useful feedback to lawmakers that will help guide them in terms of prioritizing the use of the fiscal space that we have. How much do we have? Help them figure that out, and then help them find the limits and give them better feedback. So I mean, we've done this. Historically, we've done this. So economists used to do this during and after World War II, through the 1950s. We were actually pretty good at this. We just stopped analyzing proposed spending for inflation risk because we just started thinking of that as something the central bank will take care of.
It sounds like focusing on idle real resources as opposed to an abstraction on potential GDP, for example.
That's right. I mean, and that's another area where economists are beginning to do the hard work that, I think Chairman Powell would tell you that we don't have particularly good models to give us the sort of warning sign when inflationary pressures are beginning to mount and build. We're so used to looking at the labor market and specifically at U3, and we think that that gives us the information that tells us when inflation is around the corner. I think that we've consistently underestimated the slack in the economy. And, I think he'd be one of the first to tell you that. So there are economists, there are financial analysts. I know many of them. There's a team of Italian economists who've published some work at the Institute for New Economic Thinking, trying to better model potential output or fiscal space to get our arms around these sorts of questions. So we have work to do in this area, but I think we're capable of doing a pretty good job.
So Paul, similar question. President Biden, President Trump calls you on January 21st. What can we do? How much room to maneuver do we have? How do you answer? What is your framework for what the task for 2021 is for fiscal policymakers?
The short answer from this starting point is do however much you can get through politically. I think it's hugely important in the years ahead for us to develop a robust architecture for measuring fiscal space. And actually measuring fiscal space goes back to trying to figure out a robust theory of inflation or model of inflation, which Jay has acknowledged, as a lot of other people as well, that the Fed doesn't really have. So you gotta have a good understanding of fiscal space in the context of a good model of inflation. And that's a project for our profession in the years ahead. So I would pound the table that we need to figure out these two big issues of essentially an inflation model and a fiscal space model. But as a practical matter, on the day after Inauguration Day, regardless of who's sitting in the Oval Office, is the right answer is go big. Yes. Do not worry about the theoretical capacity that we have on fiscal side. Do not worry about how much inflation's gonna go up. Just do it. Go big on fiscal policy. Go as big as you can, and hope and pray that inflation will, as resource utilization moves up, move up, but not try to be precise about it, because what we're trying to do right now is not fine-tune inflation to 1.7 to 2.7 to 2.3 or any of that sort of stuff. What we're trying to do is cut off the fat tail of deflation. Because if this economy gets hit with another shock, which could be a second wave of COVID or could be anything, if this economy gets hit with another aggregate demand shock, we're going straight into the deflationary soup. So my number one imperative would be do whatever you can do on the fiscal policy side, in tandem with the monetary policy side, to cut off that fat left tail of deflation risk. And if you overcut it off and you end up 3 years down the road with too high inflation, it goes all the way to 3.5%, then consider that to be a success story.
Great. We'll go to your questions in a moment. If you want to go into the chat feature and either indicate you would like to ask a question by video, or you can type the question either way. I mean, it is striking, Paul, you know, you're more animated than Jay Powell, but Jay is saying pretty similar things in his own way in his congressional testimony as recently as today. And I mean, it is striking to have the central banker saying, please, like, avoiding long-term damage to the real capacity of this economy is the great danger here. And we will do whatever low interest rate policy QE is necessary to keep the cost of funding the government low. I mean, that seems like an inversion of, again, that kind of consensus that I grew up, that mental model I grew up with.
Yeah, Chair Powell is a statesman. First and foremost, what he's doing right now is amazing in that he is voluntarily, on behalf of the institution, saying, we are willing for a time to be subordinate, if you will. And I use that in quotation marks because it has pejorative connotations. But he's saying we're willing to be subordinate to the fiscal authority because we're already at zero. And I think importantly on the QE, he has not defined it from the standpoint of a number. Effectively, he's made the number endogenous to whatever the fiscal authority does, because his objective function is smooth operation of the Treasury market. So it's extraordinary what he has done, true statesman on the whole thing. And essentially what he's saying every time he goes up to the Hill is, it's your job, it's Congress's job to spend red ink. Spend red ink into reflationary monetary wine. Let me say that again. Spend fiscal red ink into reflationary monetary wine, because the Fed gets its grapes for free.
The Fed gets its grapes for free. I love it. Let's go to the first question. Ben, can we go to the first person in the queue?
Bob Hockett has a question, and your line is now open.
Great. Thanks, guys. So just a quick observation. First of all, of course, bravo as always, but a quick observation and then a question that comes off of it. So one way to view the sort of outsourcing of fiscal policy to the Fed during the 90s and 2000s, and then the follow-up of that, where you have sort of further outsourcing to more and more automatic stabilizers, is as a way of basically ducking or avoiding apparent responsibility for allocative decisions, right? For distributional decisions. So you sort of technocratize it first by moving fiscal out of Treasury over to the Fed, and then you can say, well, it's out of our hands. It's basically what Greenspan's doing, and he knows what we have to do, so just leave it to him. And then you go sort of one step further along those lines at the end of Janet's period by saying, all right, more automatic stabilizers, and that's the automaticity. Again, that's the key, right? Because then it doesn't look like you're making allocative decisions. What I'm curious about is, now that we're sort of becoming more forthright about the fact that inequality is a problem, and we're becoming more forthright about the fact that there's something very racialized about the pandemic, and that particular form of inequality, right, the sort of disproportionate impact on people of color and those who are members of sort of traditionally downtrodden groups, the way that sort of dovetails with the broader inequality question or concern, I'm wondering if you foresee a move in the near future toward a greater willingness on the part of Congress members or Fed members, but preferably Treasury members, to say, yeah, we're going to be allocative now. We're actually going to sort of exercise a sort of preferential option for the poor or the traditionally excluded. on the theory that, first of all, they need it most, but second of all, that actually would be aggregatively helpful as well, that the macroeconomy itself will be better off, that basically the rising tide that will raise all boats is a tide that we actually raise by starting with those who have been traditionally on the short end of the stick, so to speak.
Thank you. Stephanie, you want to start with that one?
I can. Well, I think Bob probably knows that, because we know each other well, that he knows that what I had in mind when I talked about the strengthening of the automatic stabilizers was a federal job guarantee, was sort of improving the liquidity of the labor market, so that as we have a lender of last resort, right, in the Fed, what we lack, Minsky taught us, is an analogous institution to act on behalf of labor, right? So that we could have an employer of last resort. You could call it a job guarantee program, you could call it public service employment, whatever you want. But this is targeted spending. And so I think it speaks to your question, Bob, which is, if you're going to have automatic stabilizers, can you direct the benefits, the resources to where they are most needed, so that you actually reduce inequality, so that it actually does that, in addition to moving the budget in the right direction. And I think that's what the job guarantee does, right? It targets the spending right at the people who are without jobs, right, and hires them. We actually did a report, again, a co-authored study available through the Levy Economics Institute, published again a couple of years ago, that in a very different economic environment, looked at the macroeconomic effects of instituting a public service employment program, basically a public option in the labor market. Anybody who wants to work and can't find a job anywhere else in the economy could be hired into public service at a base wage and compensation package. We, at the time, given the state of the labor market, found that about 15 million people on average would be in the program at any point in time, obviously more in the downturn and fewer in the recovery phase of the cycle, but that it would create about 4.5 million private sector jobs as well. So there was enough capacity in the economy to hire the unemployed, still improve conditions in the real economy, but that would have significantly reduced the income and wealth gap, as well as targeted the spending to those most disadvantaged, which also happen to be disproportionately Black and brown workers, low-income workers.
Well, you want to add anything?
Yeah, I particularly like the phrase employer of last resort. It has a better political ring than job guarantee. And we're talking about the same sort of thing. So it's really a matter of messaging here. And a automatic stabilizer, we have one now called unemployment insurance, and we're debating about how much should be state versus federal supplement and all of that. So we have the mindset of a automatic stabilizer already there. And the whole concept, we need to morph that to an employer of last resort, like we have a lender of last resort. And there are lots and lots of ways to do that. In fact, you could say PPP this spring was a mechanism of employer of last resort funneled through private sector payrolls, which I thought was creative. And in that vintage, I think we can do a lot of things. So an employer of last resort, and I think you think in terms of beyond employment, public services, obviously healthcare that is universally available and affordable is part of my agenda, certainly as a citizen, independent of the fact that I'm an economist. I think a lot of these things can, in answer to your question, Bob, essentially be directed by design towards those who have been on the short end of the stick. because they're the take-up, if you will, in the system, whether or not it is an employer of last resort or through a public option. You can have health insurance of last resort. So the concept of last resort, we need to come up with a new phrase for it, but the concept of last resort to me seems to be a critical part of where we're going to on fiscal policy, that we put on pilot, if you will, conditions in which we take care of the people at the bottom end of the distribution, but also simultaneously lift the level independent of the business cycle, which leads to discussions of universal basic income, which is a different beast than an employer of last resort. But I think that we as a profession need to be open-minded on a number of avenues to getting to the outcome we want, which is an economic outcome as well as a political outcome. And because it's a reality that the more you shift income to the high end of the income distribution, the harder it is to maintain aggregate demand, because rich people have a low marginal propensity to consume. So you don't have to be an ideologue or socialist or anything to say there is an economic problem of shifting income for 40 years to the top, which makes it difficult to maintain aggregate demand. So shift the income distribution through the fiscal authority, both for social justice reasons as well as macro reasons associated with sustainable aggregate demand growth.
Exactly.
Great. Let's do one more video question, then I'll do a text question or two.
We have a question from Ashley I. Your audio is now open.
Hi. I have a question about these automatic stabilizers again. If I understood you right, you're arguing that we have to come up with a whole bunch of programs that would address issues in widely different circumstances well ahead of time by an all-knowing, omnipotent group of technocrats. So these people are supposed to know what to do in a global pandemic and how to, quote, automatically stabilize the economy, what to do in a global financial crisis that has nothing to do with the demand shock that we have experienced in the pandemic, or in a bursting of an asset bubble, and the asset class might be different each time. So I'm just trying to understand. So you're arguing that these technocrats will come up with all of these solutions and they will be pre-agreed, and therefore the Congress will just put it into action with no debate. And therefore fiscal policy, otherwise known as spending taxpayer resources, will not have democratic accountability? Are you arguing this? Or what am I missing here?
Paul, go ahead.
If I can get on this, in that I am certainly not arguing for the economics profession to come up with a full suite of detailed automatic stabilizers for all possible uncertainties in the future. I want to go on the record categorically saying I'm not in favor of doing that.
That's a good start.
I'm in favor
what is the argument?
changing a mindset that fiscal policy can be used for these endeavors. And if you want to put a sharper point on it, I want to change this mindset of deficit neutrality, that everything has to be paid for, and that it's the Fed's job to manage the economy. And so changing the mindset away from the nonsense that Stephanie was observing when she was in Congress is my number one objective. It's not to have a detailed roadmap for all contingencies going forward.
Stephanie, do you want to add to that?
Sure. Look, we have automatic stabilizers. We have loads of automatic stabilizers. The problem is that they aren't powerful enough, right? And that was Janet Yellen's point, strengthening them. Can we strengthen some of the existing stabilizers where we don't have to invent something new? We can just make existing stabilizers more generous. That's one option. We can introduce new stabilizers. Senator Schumer and Senator Wyden introduced legislation just a couple of months ago, which would have been a new automatic stabilizer. It would have said, you know, the debates over this $600 a week top up in federal unemployment compensation. Senator Wyden, Senator Schumer said, look, we are going to keep fighting because the top up expires and then we come back to Congress and we say we have to extend it and then we don't get enough votes to extend it. We should make it automatic through some date in the early part or middle part of next year. So that $600 payment will continue. This is their proposal for workers who are unemployed, looking for work in states where the unemployment rate remains very elevated. So if it was above some threshold, 11% or whatever, you keep getting the $600 a week in that state. If you live in a state where the unemployment rate is lower, you get $500. It depends how low it is. You might get $400, you might get $300. That's an automatic stabilizer where the payments continue at an elevated level and the payments are contingent upon changing economic conditions. That's an automatic stabilizer. The federal job guarantee, if you look at the Levy report that I co-authored, you will see this is a proposal for federal funding, and that's it. That's where the federal government's role begins and ends. It's the federal funding. They can establish broad parameters for the program, but the program itself is meant to be highly decentralized so that the jobs themselves come from the people living in the communities where the work will be done. They know best. This isn't a technocrat in Washington, D.C. saying the work that needs to be done in this small community in northeastern Oklahoma is this type of work. The Fed doesn't know. The federal government doesn't know. The people living in the town in northeastern Oklahoma know what they value. They know the work that needs to be done in their community. They can propose jobs that can be approved and on the shelf. On the shelf means that everything doesn't get done all at once. Work gets done as the economy releases workers, as people transition into this program. There's work for them to do. And then when the economy recovers, they transition back out. The federal government is simply providing the financing.
Great. There's a couple in the text chat, a couple of questions along the lines of, you know, we've had this kind of monetary policy driven policy environment for a long time now. What are the distributional implications in terms of income inequality of relying on monetary stimulus in place of fiscal? You know, are there policies to offset the unintended consequences of asset inflation? Is there a way to improve the transmission mechanism so that more of the monetary expansion supports the real economy, not the financialized economy? Paul, is there a way to square that circle?
The easiest way, or the most straightforward way to deal with the gross income and wealth inequality of the paradigm that we've been working with for decades is simply change the paradigm. I don't start with a presumption that we have to punish the winners of the last paradigm in order to take care of those who were the losers, who will be the winners in the new paradigm. I think that is a very wrong way of looking at it. I don't think you need to punish Wall Street in order to help Main Street. In fact, ironically enough, if you use fiscal policy robustly, and that includes a lot of various things, I will just say, use fiscal policy robustly to deal with inequality and social justice issues, strengthening aggregate demand, I think actually it makes the job of the Fed much, much easier. And if anything, it would tend to increase the natural real rate of interest known as R star, and an increase in R star would take the bubble risk out of the economy. I mean, the big thing that's really been driving Wall Street for the last 20 years is the fact that the natural real rate of interest has secularly declined because we've had a deficiency of aggregate demand and have undershot our inflation target because Nehru has fallen. So actually, if you can get fiscal policy right, theoretically, and I think as a practical matter, it will tend to lift R star, not now, but over time. And lifting R star is the best prophylactic I can think of against bubbles on Wall Street.
Great. Let's go to the next audio question, Ben.
We have a question from Aristos Constantine. Your audio is now open.
Aristo
All right.
also left a text version, so I will read it if he's.
My apologies. My apologies. I'm here. My question was simply, what parallels do you see in the EU, if any, and what are your thoughts on the EU's response? And if we could consider EU-level actions versus what member states should or could do independently now that the EU has suspended deficit limits until 2022, in particular since it's likely that EU fiscal and monetary mechanisms are going to prove inadequate.
I'll let Stephanie take that one.
Yep.
Well, I mean, that is the thing. You put your finger on it, right? Madame Christine Lagarde has stepped up, effectively restoring monetary sovereignty for countries within the Eurozone. Now, how temporary that commitment is, we will wait and see. But she has effectively, and the EC, I mean, the suspension of the Stability and Growth Pact, together with the ECB bond buying, has basically meant that Italy can run any deficit that it decides to run, and it doesn't have to worry about yields blowing out and a debt crisis and so forth. So, you know, I guess my big concern is at what point does that commitment begin to wane? And that's everything, because look, you know, we know what happened to the Greeks, to the Greek government last time. They were told now is the time for austerity, you know, the conditionality. And if the Italian government is going to be told, sort of on the other side of this, that they have to work very hard to, you know, cut spending aggressively and so forth in order to try to bring this debt ratio of 170% or whatever it is back in line with the Maastricht Treaty and Stability and Growth Pact guidelines, I think it's going to be an unimaginable disaster, and I think it will undermine the project. But for the moment, the currency issuer is the ECB, and the ECB is doing what must be done and what only they can do to hold things together and to allow governments to run fiscal policy to support economies. So I'm optimistic, but with you know.
You've seen enough weird things happen in European governance in the last
yeah.
couple of decades.
Yeah.
Let's go to the next audio question.
We have a question from Michelle Walker. Your audio is now open.
Hi. Oh, yeah. I'd had the question earlier about the unintended side effects of QE, and you know, I'm wondering if there are things that could be done with tax policy or creating of new vehicles for investment in the real economy. Other things that you know, in the area of transmission mechanisms that could help to take some of these market bubbles and get more of that money into the real economy. Even after the corporate tax cut, if you're investing long term, your capital gains taxes are still lower than what they would be if you would invest in the real economy. So if there's just a way to, you know, to get some of that liquidity moving through the economy, so we're seeing, you know, fewer buybacks and more investment in companies, more investment in jobs, and also helicopter money that's actually getting to the very bottom of the economy so that it's trickling up.
I mean, Stephanie, the one thing Jay Powell keeps saying is we, the Fed, have lending powers, not spending powers, that they feel very comfortable buying they feel somewhat comfortable buying corporate bonds and injecting liquidity. They feel much less comfortable with anything that's a transfer to a business or individual. Is that the right framework, or should we hope for our central banks to play a more active role in the kind of stuff you're talking about in terms of directly pumping money into the economy?
No, I mean, Jerome Powell has said it. I think he says it every single time he speaks in public. He says the Fed can lend, but the Fed can't spend. If the question that she's asking, and I know Paul wants in on this also, I think the answer that I'll give to the question, how do we get businesses to stop with the buybacks and other things and to make real investments in the economy? The answer is simple. You swamp them with customers. You swamp them with customers. When consumer demand is robust and businesses do not have the capacity, right? The factories, the machines, when they can no longer keep up with consumer demand, I promise you, they will start parting with cash that's parked on the sidelines. They will start making the real investments. Until then, why would they, right? There's simply no good economic reason for businesses to build capacity, to spend on real capital investment in an economic environment in which consumer demand is massively depressed. So get consumer income up, and sustainably so, get wages up, get consumers swamping businesses with customers, and if you buy it, there's sort of a twist on the if you build it, they will come sort of thing. If you demand it, they will supply it, they will produce it.
Paul, you want to dive in?
Yeah, I'm coming from the same place, and Jay says time and time again that he's in the lending business, not the spending business, and that if we want to have robust aggregate demand, which is spending, then the fiscal authority, duly elected and therefore accountable to democracy, has got to take the lead role. Now, as a practical matter, the monetary authority can lend to the fiscal authority. In fact, the monetary authority can de facto turn any piece of federal debt into a perpetual, meaning it never has to be paid off by simply rolling it in perpetuity. So the Fed is ready, unambiguously ready, to make smooth financing for as far as the eye can see, plus a day, for whatever the fiscal authority wants to do. Now, if you do too much of it, 5 years from now, 10 years from now, you have too high inflation, that's okay, because we know how to deal with a too high inflation problem. It means that your economy is too hot. The asymmetry is that when the economy is too cold and your income distribution is skewed to those who are well off, you don't know how to fix that with monetary policy. And it's not a matter of incompetence, it's a matter that the tool don't work. So essentially, this shift to a fiscal policy dominant world is economically mandated. That's clear. I think you're seeing it on this side of the pond and the other side. The issue is for the body politic to catch up to the new economic necessity. And in part of catching up is actually to lose the baggage of the prior regime. And as Stephanie noted, that baggage is still around. And I keep hearing it, from a standpoint of comments about the deficit being so incredibly big, and that, the new president will have a limited cupboard of fiscal space. That's just nonsense. The cupboard is as big as it needs to be, and the Fed has the ability to fund the cupboard effectively unlimited.
So this question kind of goes to the more conceptual issue behind that I'll pose to Stephanie. It's a text question from Jonathan Carmel. Does every country have access to massive deficit spending? If not, what exactly defines who does and does not? And can one country move from the ability to have deficits without inflation to having inflation? What are those conditions? This is kind of MMT 101, but might be useful at this point.
Yeah, well, so when we talk about the U.S. having the capacity, as Paul said, the cupboard is as big as it needs to be. We have institutional arrangements here. We have a central bank, and we have Congress, and we have a treasury, and it is our government. In the Eurozone, which we talked about a little bit earlier, you don't have those institutional arrangements. Each member country did have, but by joining the euro, they put themselves in a position where they retain, fiscal policy at the national level, but monetary policy is at the supranational level. And the central bank became the currency issuer. This ECB does not automatically clear all payments authorized by the Greek government or the Italian government, the way the Fed will clear all payments authorized by Congress on behalf of Treasury. We have a sovereign currency, a floating exchange rate, and we don't borrow in foreign currencies. So the US, Australia, Canada, the UK, a number of countries have what in MMT we refer to as monetary sovereignty, or a high degree of monetary sovereignty. There are countries that have little or much less monetary sovereignty than the US, either because they've borrowed heavily in foreign currencies, because like the countries in Europe, they have separated their fiscal and monetary authority so that they no longer have a central bank that stands prepared to resize the pantry as needed, as Paul said. So no, every country does not have as much fiscal space as those with a lot of monetary sovereignty. And they're much more limited in terms of what they can do. They're more vulnerable to exchange rate fluctuations, less capable of managing their own interest rates. Japan clearly does, the US does, ECB does now on behalf of member governments there, but there are countries for whom borrowing does place them in a position where they're essentially at the mercy of capital markets, and they will have to pay rates that are established in capital markets rather than being in a position to determine rates they pay on their own securities.
Paul, do I see you wanting to chime in?
Yeah, it's clear that America has what Charles de Gaulle said a long time ago was an exorbitant privilege, which is effectively what he was talking about, is monetary sovereignty. And America is the global reserve currency, and you can call it an exorbitant privilege, but I'm actually looking at it as an extraordinary responsibility. Because as Stephanie was noting, a lot of countries don't have the degrees of freedom that we in the United States have. They are price takers or users of somebody else's currency. So if you're at the center, you have an exorbitant privilege, but you also have a exorbitant or extraordinary responsibility to actually get the currency into your own economy and then into the global economy. So I would look at that as not just a domestic responsibility for our Congress, but as part of our leadership in the global arena of providing an umbrella for the rest of the world to do that which they can't do on their own. And I think this is particularly the case for the emerging markets, who have complained quite appropriately many, many times that they get whipped around by this monetary policy dominant regime in the United States. And the best thing that we can do for them is essentially move to a fiscal dominated world, not a monetary policy dominant world. And here I am not intending to criticize the Fed whatsoever. I've spent 4 decades doing nothing but watching the Fed. It's just that circumstances have changed. And if circumstances have changed and you don't change, you are the fool in the game. And the Fed is not the fool in this game. The entire Fed, led by Jay, gets it It is a handoff to the fiscal authority, and Congress needs to run with it.
So this is a side effect, what you're describing, of being the world reserve currency. They make decisions worrying about the US economy, but if they tighten the money supply, they're tightening money and credit all around the world in ways that cause huge problems in Brazil or Indonesia or name a country.
It's huge externalities for the rest of the world, particularly the emerging markets, if the global reserve currency is running a monetary policy dominated monetary fiscal policy mix. Yes. So actually, reducing that externality is an endogenous consequence of moving to a fiscal policy world. And it's also a really cool thing to do.
Great.
I think Ben has a few more questions that he's teed up.
Yep.
We have a question from Stephen Blitz. Your audio is now open.
Okay. Hey, Paul, how are you? Good to sort of visually see you. Anyway, couple things. Paul, I'm a little bit older than you. And so I came into starting to work in the mid-70s. And what I remember as the answer to the inflation of the time was indexing and wage and price controls. And that was the big argument on that side. And I kind of think of MMT a little bit in those kinds of terms. Now, in terms of what everyone's talking about today, there seems to be two currents and themes. One is responding to the COVID. And to me, you're 100% right. There should be no fiscal restraint, income transfer to hold people together who've been unfairly impacted is the answer. It is PPP, unemployment insurance, however you want to snap. That's the answer until it goes away. But with MMT and what you're also talking about going farther ahead in time once this is passed is a program of infrastructure building and all those kinds of things, which I have no argument with. I have an argument with the zero interest rates and the distortions that creates in portfolios and people's behavior. But the issue that I have is not the economic one, it's the political one. There's always the perception that the people in charge will be these wonderful, like-minded individuals like us. And the truth is that no one can convince me that at some point, once somebody who's president and a party in power recognizes that deficits are free, that their response is, you know what? Let's set the tax rate at 0. And let's just do that. And that will be our stabilizer, as opposed to transferring income, as opposed to building things and stuff like that. And further, once you give the central bank to, in a sense, not a sense, give it over to the executive branch, which I know we're talking de facto kind of is at the moment, I get that. But once you officially make it part of the executive branch and you make deficit 0, you create the exact opposite of democratization. You create almost a fascist state where the president, whomever he or she is, has absolute total control to do whatever they want. And that's the political, forget about the economics.
Steve, let's wrap it up.
Let me push back on that at a fundamental level. The Fed was created by Congress. Congress has the power to create money and regulate the value thereof, not the executive branch. Now, the Fed technically is under an executive branch umbrella, but the constitutional power for monetary arrangements comes from Congress. And I want to believe that democracy has the power through Congress to keep the executive branch from doing what you are suggesting. So I'm not suggesting that the Fed be moved as a discretionary agency underneath the executive branch without effectively a legal mandate from Congress. That is the exact opposite of anything I've ever mused in my lifetime. It comes back to the whole issue that Congress, the first branch, gives you the legitimacy of democracy, including the ability to check an authoritarian executive branch. So I understand your concern, but it doesn't bother me because I believe in the first branch in the Constitution and the power of democracy behind it.
Let's go to next audio question.
We have a question from Aaron Chandran. Your audio is now open.
Hi there, Aaron from Chicago. First, thank you both for participating in this event. My question is particularly for Professors Kelton and Robert Hockett, as well as Mr. Dan Alpert. So I think I seem to understand the concept of deficit neutrality within the framework of MMT, but it also seems to be contingent on the fact that we remain the world's global currency of reserve, which seems to be kind of a circular argument in my mind. And I'll color that question a little bit with a quote that Mr. Alpert gave in an op-ed a little while ago in the Times. The quote goes, "The rich countries of the world, while still rich, struggle with monumental levels of debt, both private and public, and unsettling questions about whether they can compete globally." So I wonder how we kind of square these concepts, and perhaps I can incite a debate or, make a consensus here. So,
why do I suddenly feel like Lindsey Graham? Go ahead, Stephanie.
Oh, so look, you do not have to be the world's global reserve currency country in order to sustain fiscal deficits over time. Okay, that's clear. Look at the UK. Look at Japan. We could go for a lot of countries here. Okay, so it doesn't have to do with that. It's when we use this word deficit, and you just use the national debt, these are problems for me, okay? Because what's really happening, we're talking about the difference between two numbers, okay? We use this word deficit to describe a situation wherein the government is doing more adding than subtracting. That's all that's happening. But instead of recognizing that what's important is what's happening outside the government, right? In the non-government part of the economy, we focus on the government's ledger, the government's balance sheet. Oh, there's a deficit. Oh, this is unsustainable. It's not unsustainable. The question is, if the government is doing more adding than subtracting, let's use the US case, we could use Japan. If they're adding more yen than they're subtracting, somebody in the economy is ending up with those yen. So the question is there a point at which it becomes unsustainable to continue adding more than you subtract? Okay, and what would that look like? In MMT, we say the limits show up in inflation. The limits do not show up in insolvency. Okay, Japan, the US, the UK, Canada, Australia, New Zealand are never going to be pushed into a situation where they cannot afford to meet their obligation, right, principal and interest, on outstanding government securities. They're not going to end up like Greece. Okay, but there are limits, and we find those limits in the real productive capacity. The real resource constraints are in the real economy. So could a government add more than it subtracts? We call it deficit spending. Could a government continue to do that year after year, decade after decade, without negative consequence? The answer, I think, is given by the history. Yes. Yes, governments do that. Why? Because the real economies make so much space because of the lack of total spending. Remember, the government has to share spending space with all of the other players in the economy. And if you have an aging society, as in Japan, if you have widening inequality, as Paul keeps bringing up here, and the income is going disproportionately to those at the top with a lower marginal propensity to consume, it leaves behind more space for government to come in and spend into the void. So depending upon a lot of things, you can have fiscal deficits year after year, decade after decade, without negative consequence. This whole thing about the debt is like another hour-long conversation. We're already over. But for me, government securities are just another form of payment, right? We get all twisted around, I think, because we're so used to thinking of what the government is doing when it sells bonds as borrowing, right, to finance spending. I don't look at it that way. Again, I would need a lot more time to fully flesh this out. I do it in the book, but think of the government bonds themselves as just another form of payment, where a government like the US, Japan, the UK can choose to make its payments in the form of currency, right, reserves, notes, bills, coins, notes, or it can choose to make some of its payments in the form of government bonds. And that's what we currently do. Paying it back involves nothing more than shifting funds from one account at the central bank to another account at the central bank. That's all that's happening. And there's nothing that's ever going to compromise the US government's ability to shift funds from one account to another, the British governments, the Japanese government, the Australian government. So there is no day of reckoning. There is nothing to pay back on the other side. I just think we're getting a lot of these things wrong.
One thing maybe I'll just add really quickly to get to the question, because I think one of the confusions that comes up has to do with, all right, to what extent is MMT sort of only applicable to the U.S. or somebody who issues a global reserve currency? So I don't know if this is an MMT answer, but I think it's certainly an MMT friendly answer. And Stephanie can then tell us whether it counts or not. But if you just think of it in terms of, just remind yourself of the role that money plays as something that is a claim on resources, right? And if you are a sovereign that has essentially authority over the entire currency, or all of the currency in effect that's used within your jurisdiction on the one hand, and at the same time you have territorial jurisdiction over all of the material resources that you need on the other, then you're golden, right? Then you're fine. You're almost sort of literally golden in the sense that your currency really is as good as gold. The only time a problem comes up, it seems to me, is if the government that issues the currency and has the authority over the currency does not also have territorial jurisdiction over all of the resources that are needed by the population that uses the currency. In that case, of course, it has to import. And in that case, in turn, then there are constraints on the usability of its currency elsewhere to get the remaining resources. If it happens to issue a currency that is globally in demand, it's the global reserve currency, then again, no problem. But there is a kind of bigger problem, nevertheless, and that is that generally the countries historically that have issued global reserve currencies have typically had territorial jurisdiction over almost as many resources as they needed to, right? They had that kind of power that came from that control over resources, which then translated into a kind of power that ended up being monetary power. So whether the UK, for example, right now, which doesn't have territorial jurisdiction over the kinds of resources that it had 100 years ago, could operate with the same degree of flexibility that the US could, it's pretty easy to answer that question, right? The answer is no. Whereas in the Victorian period, it probably could have, had it not been for the gold standard. But I think that might be the way to kind of fuse or synthesize those two sort of lines of inquiry together. Does that sound right to you, Steph? Is that at least MMT friendly?
Yeah, I think it is. Dan?
Oh, on that note, and thank you, Bob. I think that was a good way to wrap it up, and I agree with your observation. I want to thank everybody. I want to thank Neil Irwin, who I really have enormous respect for, and I think who was able to bring to this discussion some degree of caution and concern about where we're headed. Of course, I want to thank my colleague Paul McCulley, who taught me everything I needed to know over the last few decades, and of course my dear friend Stephanie Kelton, who is leading the way into this post-Keynesian future that I think is going to prove to be not only desirable but quite necessary. So thank you very much. I hope to see you again on the next installment of the World Economic Roundtable. Good night.
Thank you.